The average 30-year fixed mortgage crossed over that 7% rate line on Monday, and that's the first time that it's done that since December of last year. Those rates, those mortgage rates, they have been on a wild ride. We had good news from the Fed, and those rates were dropping. Good news being did not raise interest rates, so the mortgage rates correspondingly went down slowly. We saw those rates in the sixes, but it's been a wild ride. So let's see what the data is telling us moving forward as we get into this heavy selling spring season.
I'm Kiwi of the coast, the agent with the most.
Mortgage rates don't follow the Fed directly. They're loosely tied into the yield on the 10-year Treasury, but there's other factors. And that yield on the 10-year Treasury is heavily influenced by the Fed's view on what's going on in the economy. Now, that rapid increase over the last couple of days, that's not surprising because the Fed has basically said it's not going to be raising rates, keeping them stable, and they're not, and this is the key, they're not going to be dropping those rates anytime soon. So of course those mortgage rates tend to elevate a little bit over what we've seen, and that's why there's that volatility in the last couple of days. Now the economic data, boy, that has the final say, and it's been a bit of a rocky road there. We're looking for a little bit of bad news actually to help with those mortgage rates, and we just haven't seen it, have we? Now, as those mortgage rates fell those last 2 months, we saw an uptick on a couple of things. The number of homes on the market, you'd think that'd be counterintuitive, but also we saw an uptick of the number of buyers out there looking and of course making applications for mortgages. Total inventory, though, is still low and we need a lot more homes. We've got that perfect storm of low inventory and low affordability, and that has got to be helped by lower mortgage rates, and they're just not coming back just at the moment. And we saw that, those high prices, low affordability, making 2023 one of the slowest real estate markets in history, I think going back 23 years. By slowest, I mean the lowest number of sales. 2024 is predicted to be better. The economy's kind of leveled out, inflation seems like it's under control, but of course the job reports has been good, hasn't it? So the old Fed isn't encouraged anytime soon to lower those rates. Now the strong job market, of course, is good for the buyers out there because guess what? They can qualify for mortgages. Their jobs are holding steady. Some of them have had pay raises, so that's good news if we can find more homes for them to buy. And of course those mortgage applications, we saw those rising in the last couple of months. That was good news, and now they've kind of fallen off a little bit. So it's as if they've taken the pot off the boil and those rates have steadied and gone up a little bit, and it's taken a little bit of the enthusiasm out of the buyer populace. The spring housing market, of course, is fast approaching, and those all-important mortgage rates tend to dampen the buyer's enthusiasm. But we're going to see more homes selling in spring than we did last year. That's Kiwi's prediction. The most recent housing data in December shows that the average house price was $382,600, and this is over a 4% increase from December in 2022. That was the sixth month-to-month consecutive gains, and we saw a peak there of over $389,000 for the average home. Now, given those high prices, just a small change in the right direction for mortgage rates is going to have a huge effect on that buyer mentality and the number of sales. Rest assured, a small drop can mean a couple of $100s in the buyer's pocket or his ability to afford a little bit more home. So what's next? The future of those rates in 2024 is a function of if and when. And this is a function of, is the Fed going to look to see and ease those rates so that the Treasury drops a little bit with mortgage rates following suit? Otherwise, we're going to look at rates probably around the sevens for at least the next 6 months. But inflation is even a bigger factor over the labor market. So if we see inflation starting to cool, that should ease things a little, and we're hoping that we can change the course of those mortgage rates and they'll end up ducking below 7%, which is what we need them to do, and this buyers certainly do. That real estate market, it is constantly changing. Click on the video on your screen right now so that I can keep you up to date on inventory, changing mortgage rates, all those factors affecting you and the real estate market. See you there. the room.